Hi everyone, welcome back. Hope you're all doing well. If you're new to my videos, my name is Josh Elba. I do business and personal finance advice videos. I also have a new business owner coaching program that teaches you how to start your own business. And with that, inside that program, there's about a guarantee of about $9,300 in cash incentives, bonuses to start your business, which pays for the program itself. So if you're looking to scale your business, if you're looking to start a business, if you're looking for an extra stream of income, then there's guarantees of about $10,000 in cash that I can help you there. Now, the point of the video today is I wanted to give everyone watching this video something to think about in regards to scaling, growing, running your business. I think every business owner needs to be a good investor. And the reason I say this is because whether you're a business owner that trades stocks or you're a business owner that details cars, or you sell t-shirts, or you do landscaping, whatever the case may be, from an investment standpoint, there's two investments, right? There's your money, and this is all just stuff to think about. There's your money, and there's your time, right? The time's more valuable because you can't get that back, which is why think of your money as, like Kevin O'Leary would say, think of your money as little soldiers that you put out and you send out to war, and then they bring you prisoners and the other money, like they bring you prisoners of war, and that's all their money. That's more dollars, cash coming back. But regardless of what the business is, business owners are good investors because the way to scale is by investing back into the business. You're buying more time, or you're potentially buying more money. And then it breaks down to what's your risk tolerance. So the risk tolerance comes into play. Let's say you joined a coaching program and you got $10,000. You could put that in 3%, like 1 to 3% bonds, and it'd be pretty safe, presuming that the country doesn't go bankrupt. But the route we're on right now, it's not looking, honestly, it's not looking too sharp. But like let's say AAA rated bonds are pretty safe, or CDs at a bank, let's say, or even a savings account at a bank, maybe getting 1.8%, if that. Now these things are safe, but when you send out your $10K to the bank to get 1.8%, let's say on a yearly basis, you're only getting $180 back on that $10,000. Whereas if you had a higher risk tolerance, or if you found a way to lower your risk based on skill set, for example, the exact same thing, you take the $10,000, you run a Facebook ad, and you run 100 different Facebook ads, and you spend $50 a piece on each of them. So you just spent $5,000 in ads, which means you probably reached, let's say, about 1 million plus people on Facebook. If they're in your target market for a landscaping company, for cardio, whatever the case may be, whatever this you happen to be selling, and you know that for every dollar you spend on ads, you get $2 back, but you might have to spend $1,000 or $5,000 or $20,000 to fully recoup that because it takes so long time-wise. It's the exact same thing. Same exact thing with employees. You could do the work yourself. It doesn't really make sense to. If you have the dollars, if you have the credit, if you have the cash to pay somebody to do the work, because when you're doing the work, you can't be growing the business. If you're a business owner, you need to be working on the business, not in the business. Big fucking key. And those aren't my words, but they worked for me, so I'll say they're my words too. But it's the exact same thing as a Facebook ad, or investing in a bond that's going to pay you out, or investing in a stock where, let's say, you only need to win a low percentage of the time because your wins equate to 5. Let's say you invest $1, right, and you either lose the full dollar, or you make 5. You can be wrong a couple times, but when you hit the 5, then it makes back what you lost as well as a profit. So that could be a trading example, not necessarily investing. But the employee example would be, which is what every Kroger might, like, think about somebody working at Kroger. They get paid $8 an hour. Kroger as a system, because Kroger made the system, their management, the owner put that system in place. They created the system, and they get these people, if they want jobs, this is what their negotiator rate is. If you don't want to work here, don't work here. But they make their $8 an hour, but the value that they provide to Kroger might be 100, potentially even more, because that person gets to check out people. If every bill is $50 to a couple $100 in an hour, that person might scan $5,000 to $10,000 worth of stuff in an hour, potentially. Now, they're not salespeople because Kroger did the marketing. Kroger did the research to find out where the best location for the store would be. So on the employee side, if they were to provide more value, let's say maybe I don't think they would need a good degree, but for Kroger, you might need a degree to get into like a managerial position, or to work in like high-level managers, managing franchises, or like finding places, like whatever the case may be. I'm getting off topic. But that Kroger invested $10 at an hourly rate, $8 at an hourly rate to help someone, to help put the system in place that's going to increase their sales potentially $5,000 an hour. Now, whatever they net on that, obviously there's overhead, there's all these other things, but from a very specific, like simple level thing. Think of a small business owner that might have one, like they have a corner store working at a gas station. They could hire somebody for that $10 an hour, and then they could be working to scale, do something else. If the person they hire brings in $20 worth of value or an hour, or $50 or $100 in net profit value on an hourly basis, and they're only paying them $8, that's a good investment, because all an investment is a cash outlay for a promise, for an expected promise of higher future returns. So closing up, one of the things Ray Dalio talks about is asymmetrical risk reward, which I absolutely love. I love it in day trading. I love it in Facebook ads. I love it in women too. And the concept is, when I used to run Facebook ads really heavy, which I'll be getting back into soon, it just hasn't been my focus lately. I knew for that every $40 I spent, I could generate $900 well, every $90 I spent for one company, I could do $900 in revenue. And every $40, I could do like $400, $411 net. So if I know that every $40 I was spending at a tax return, I should be dumping all my money I can into that potentially. Aside from like the law of diminishing returns, like over time, I can't just put $1 million. Like, I don't think it just compounds that easily, but that would be the best way to scale. When you see that return hitting based on your risk tolerance, find asymmetrical risk rewards that you can invest in to grow your business, and then use the cash flow from that to either diversify or put it back in, whatever makes more sense. Use some thought. But I hope this video is helpful from an insight standpoint of what I recognized on the asymmetrical risk reward side, because it lowers your risk a lot. Because it lowers your risk a great deal. If your losers are 1 point, but if your winners are 5, you can be wrong a lot. But then you gotta put your ego to the side, which is a whole nother video. So thanks for watching, everyone. The biggest thing I would say right now is, like, yeah, I want you to do the coaching because I know it works, but if you don't want to do the coaching, at least get in on the credit program, because that's $10,000. You don't need credit. It's $5,000 to $10,000 in cash bonuses in your pocket just to start a new business. So that's what I would do if I was you. And I know $10,000 would have helped me when I started my companies. So I want you to have the same opportunities that I know about now. Thanks everyone so much for watching. I'll see you all in the next video.